Hey, how you doing? This is Adam Post, publisher of more than 1,000 comic books and marketing expert covering Disney Wars, the ongoing hostile takeover explained. Let's get into the story. Before we do, please be sure you are subscribed to the channel. Click the bell for notifications. Give me a thumbs up. I really appreciate you guys. Coming from the Wrap, the Disney Nelson Peltz proxy battle explained. The activist investor is pushing for 2 board seats at the House of Mouse to try to boost transparency, focus, and accountability. Okay, first things first, what's an activist investor? An activist investor has nothing to do with the woke or social justice people. An activist investor typically is a specialized hedge fund, so an investment group who buys a significant minority stake in a publicly traded company in order to change how it's run. Nelson Peltz is a self-made billionaire. He's very good at this stuff, but he's made a great career for himself improving big companies and working with big companies. One of the companies he's worked with is Unilever. Another one is Wendy's. Another one is Heinz. He's been around a lot of big companies before and has a good reputation for making positive change and improving the value of corporations. Activist investor and Trian Fund Management founder Nelson Peltz's proxy fight with Disney is heating up as the House of Mouse has sought reinforcements from shareholders ValueAct Capital and Blackwell's Capital. This is about the control and the future of Disney and all of the divisions, companies, and brands that Disney controls. According to Disney's latest proxy statement, Thursday marked the deadline for any shareholder who wanted a board nomination or other business considered at the company's 2024 annual meeting, which is expected to take place this spring. Expect a feisty meeting. The Wrap broke down the corporate intrigue and its major players. What's a proxy fight? Good question. A proxy fight is when shareholders join forces to try to pressure a company's management or board of directors to make changes using rules of corporate governance. That pressure is normally applied by gathering enough shareholder votes to win a vote for the corporate level change. A proxy fight strategy is also common in hostile corporate takeovers. Prior to going the route of a proxy fight, shareholders could appeal to a company's board directly to express their dissatisfaction with a specific decision by the company's management. Disney extended an offer for Trian, Nelson Peltz's company, to meet with its board, but informed the firm that it was turning down its request for board representation, including for Nelson Peltz. What does Nelson Peltz's company actually want? His company, Trian, is pushing for changes at Disney, including a plan for future leadership. Peltz wants Disney's board of directors to develop a succession plan for CEO Bob Iger, who returned to the company as chief executive in 2022 after previously serving in the post for 15 years and retiring in 2026. This is not an unusual request that Nelson's people are making of Disney. Major companies, public companies, do need to have a succession plan in place, even if their CEO is not leaving. A CEO, chief executive officer, is an important person at a public company. A company the size of Disney should certainly have a plan, and it should certainly be in place to take over for Bob Iger. As of right now, Bob Iger is supposed to leave in 2026. There should be a plan in place. Something is very wrong that there is not a plan in place. Nelson Peltz also wants Disney to align compensation with performance, cut more costs, and reinstate Disney's dividend by fiscal year 2025. Last February, Peltz decided not to go forward with a proxy fight after Disney announced a plan to cut $5.5 billion in costs, which have included 7,000 layoffs and job cancellations, the removal of select content from its streaming services, and a diminished content output. Iger raised that target by another $2 billion to $7.5 billion during Disney's fourth quarter earnings call in November. Peltz and his company Trian argue that Disney has woefully underperformed its peers and its potential, and that its turnaround does not appear to be materializing. They cite tens of billions of dollars in lost shareholder value, 70 billion if you want to know the total number, and that is a lot of money to be knocking off the value of Disney. Also, a meaningful drop in consensus earnings per share estimates for fiscal years 2024 and 2025, and studio content that, quote, continues to disappoint consumers, slowing the speed of the flywheel and threatening future earnings growth. When the Peltz people talk about flywheel, what they're saying is Disney's brands that used to excite and inspire people no longer have that magic to them. They've lost it. Disney has gone over to focusing on pushing a political agenda and forces it into all of their content. So one side of the aisle is interested in the content or is willing to look at the content, and the other side of the political aisle sees the ridiculous political content in the stories and says, this isn't Disney. These aren't these brands that we're used to and that we love. And they run the other direction. So Marvel's destroyed. Pixar's destroyed. Lucasfilm is destroyed. Disney's classic brands are destroyed. Disney's princesses are destroyed. All of this because Disney's management and board of directors are focused on pushing a political agenda. That's a key part of what Peltz wants to see changed at the company. Just go back to what works. It's that simple. Produce stories that everyone loves. More generally, Trian said that Disney appears no closer to adequately addressing the compensation misalignment, governance, and succession issues that have plagued the company for decades. The compensation issue for management is also that people are being paid millions of dollars while the stock gets absolutely trashed. The stock is down more than 50% off of its high from a couple of years ago. Why aren't management either being forced to leave or at least being financially punished for that? There's no explanation. The root cause of Disney's underperformance, Trian added, is a board that is too closely connected to a long-tenured CEO and too disconnected from shareholders' interests, and that lacks objectivity as well as focus, alignment, and accountability. And it's another major issue that Nelson and Peltz has with Disney's management and its board of directors. The board of directors don't personally own a lot of Disney stock. So if the stock goes down, it doesn't personally really financially hurt the board of directors. That's why Nelson Peltz has said, look, put me on the board. I've got significant money invested in this thing. If the stock doesn't go up, it's going to hurt me. So I will focus on the board of directors on helping you guys to get the stock price up because it affects me financially. The board of directors are not affected financially as it stands because none of the board of directors actually own a lot of Disney stock. Disney stock, which hit a 52-week low of $78.73 per share in October, has rebounded to around $90 per share as of Thursday's close, but remains off the stock's 52-week high of $118.18 per share. The company's market value currently sits at $165 billion, about half of its $328 billion valuation at the end of 2020. So how is investor Nelson Peltz and Trian trying to gain more influence with Disney? Trian and Peltz have an approximately $3 billion ownership stake in Disney. Much of that influence comes in the form of shares from former Marvel Entertainment chairman Ike Perlmutter. In October, Perlmutter, who aided Peltz in his first proxy fight with Disney, was let go by Disney as part of cost cuts in March, granted sole voting power over his shares in the company to Trian and Peltz, calling them a constructive voice for Disney shareholders that can help leadership better navigate the company's challenges and opportunities. Perlmutter cited their strong operating and strategic capabilities. In a statement to The Wrap at the time, Perlmutter said, as someone with a large economic interest in Disney's success, I can no longer watch the business underachieve its great potential. Perlmutter, who acquired Disney stock in 2009 following the Marvel acquisition, said he has not sold any shares and has added to his holdings over the years. Quote, increasing the value of my Disney holdings will also result in increasing the amount that my wife and I will be able to provide to the leading hospitals, medical research institutions, and other charities to which we plan to leave the vast majority of our wealth, he added. And now enter Jay Rasulo, former chief financial officer at Disney, and someone who was a longtime employee at Disney in the past. He knows a lot of the secrets of what's going on at Disney. Trian has enlisted the help of former Disney chief financial officer Jay Rasulo, who along with Peltz has been nominated for a seat on the company's board. Rasulo, who was once seen as a potential heir apparent to Iger as CEO of Disney and was ultimately passed over for the chief operating officer role, spent 3 decades at Disney serving as president of Walt Disney Parks and Resorts from 2002 to 2005, chairman of Walt Disney Parks and Resorts Worldwide from 2005 to 2009, and Senior Executive Vice President and CFO from 2010 to 2015. Quote, the Disney I know and love has lost its way, Rasulo said in a statement. As independent voices in the boardroom, Nelson and I are confident that the combination of my decades of experience at Disney, Nelson's significant boardroom skills and history of driving positive strategic change, and our combined consumer brands experience and financial acumen will be additive to the Disney board. A great, sensible statement to make. He's a chief financial officer. He worked at Disney. He knows how Disney works. There's absolutely no legitimate reason why Jay Rasulo should not be on Disney's board of directors, unless the Disney management or board or both are trying to hide something. In my opinion, they are looking to try to hide a lot of things. In addition to Perlmutter and Rasulo, Peltz has gained an ally in Ancora Holdings, the investment firm, which has approximately $8.7 billion in assets under management, own more than 60,000 Disney shares as of September, according to FactSet. Quote, "We believe Disney is saying the right things about restructuring and transforming the enterprise. Nonetheless, the addition of a shareholder representative or investor-designated directors to the board can help ensure that these efforts are carried out in the most effective way." Ancora Holdings Group Chairman and CEO Frederick DeSanto and Ancora Alternatives President James Chadwick wrote in a letter to Disney in December. The executives encouraged Disney's board to pursue a viable compromise with Trian and Peltz. Now, what is Disney doing to respond to these investors who are not happy with seeing the stock completely get trashed? Since February, Disney has taken on many strategic initiatives in an effort to address Peltz and Trian's concerns. In addition to cost-cutting efforts, Disney is currently on the hunt for strategic partners to help turn ESPN into a fully direct-to-consumer offering targeting a 2025 launch. The company has also launched a beta version of a combined Disney Plus and Hulu app, which will officially roll out in March, and said it will invest $60 billion in Disney's theme parks over the next decade. And Disney has reportedly signed a non-binding term sheet to sell a majority stake in its India operations to billionaire Mukesh Ambani's Reliance Industries. I like the deal in India. I don't see anything wrong with it. I also like the idea of investing more in the theme parks. Those investments, they've clearly said they don't plan on doing anything risky like opening a theme park in Australia or Pakistan or some new place. All they're going to do is add to their existing theme parks and expand them. That's a very low-risk thing to do, and that $60 billion is going to be spent over 10 years, which means it's not really going to be $60 billion. There'll be some money invested, maybe $10 billion, and they'll begin to recoup their investment, which will then just continue to roll over. The 10 years prior, they spent $30 billion. So given the effect of inflation, it's somewhat more money, but it's not that much more money, and the theme parks are really profitable for them. It's the one thing for Disney that really is working for them. Separately, Disney declared a cash dividend of 30 cents per share for the second half of fiscal year 2023, which will be payable on January 10th to shareholders of record as of the close of business on December 11th. The payout marks the first since the dividend was halted in 2020 during the COVID-19 pandemic. Disney has also been making changes related to its corporate governance. The entertainment giant recently amended its bylaws to increase transparency around business proposals and director nominations from shareholders. It expects to file preliminary materials for the 2024 annual shareholders meeting with the Securities and Exchange Commission, which will include the Disney board's recommended slate of director nominees. In November, Disney's board of directors appointed two new members, Morgan Stanley chairman and CEO James Gorman and Sir Jeremy Darroch, a veteran media executive and former group chief executive of Sky. Darroch's appointment is effective January 9th, 2024, and Gorman's is effective February 5th. The appointments will temporarily increase the board from 11 members to 13. Disney board member Francis D'Souza will not stand for re-election. Part of the idea of appointing these additional people was to block the number of members of the board so that Peltz would have a harder time getting more people on Disney's board. Iger, who has extended his contract through the end of 2026, has also said he will definitely step down at the end of that term, with a robust process currently underway to find a successor. The company has also tapped former Pepsi Chief Financial Officer Hugh Johnston as its new Chief Financial Officer, replacing Christine McCarthy, who stepped down to take a family medical leave in June. Johnston, who has served as PepsiCo's CFO since 2010, was a key player in the snack and beverage maker avoiding a potential proxy fight with Nelson Peltz and Trian, when the activist investor called on the company in 2013 to either merge with its rival Mondelez or split into two businesses. Which is incredible that Disney would go out of its way to hire a new chief financial officer who has dealt with Nelson Peltz and Trian before, as if that's the priority, not finding a good chief financial officer who's very important at a company for strategic decisions, for evaluating how they handle costs, for lowering costs, for making sure they're in compliance with the government for all of their filings, for communicating with the public, for communicating with their shareholders and potential shareholders. But no, Bob Iger is focused on finding people to help him stop Peltz from just having 1 or 2 seats on the board. Of course, the truth of it is that Nelson Peltz really knows what he's doing and would very quickly have control of that board of directors if he did get a seat on the board, which I think it's very likely he will. Additionally, this guy who seems like he's very capable, Hugh Johnston, has never had any media experience, but he does have Peltz experience. How that makes him qualified for a media company, nobody knows. Elsewhere, ValueAct Capital, led by Mason Morfitt, entered into a confidentiality agreement with Disney on Wednesday that will allow the firm to consult on strategic matters, including through meetings with the board of directors and management. ValueAct, which has not disclosed the size of its stake in the entertainment giant, reportedly began building its stake during the Writers Guild of America and SAG-AFTRA strikes. According to this short interview with Tom Rogers, who's a media mogul, Rogers believes that ValueAct is going to be paid a fee for advising Disney. So this is an investor group that's going to be supporting Bob Iger and the board of directors in whatever they decide they want to do, and are getting paid a fee to do it. ValueAct, which has experience investing in media and technology companies navigating significant business transformations, including Spotify, the New York Times, 21st Century Fox, Nintendo, Microsoft, Adobe, and Salesforce, also said it would support Disney's board of directors' recommendations for their slate of nominees for election at its 2024 annual meeting. ValueAct is known as a company that does do this for companies. They will support the existing management, and that's the game that they play. So of course, Bob Iger went out and developed a relationship with them so that he would not be questioned. Blackwell's Capital, which has publicly thrown its support behind Disney's turnaround efforts and previously called on Peltz to end his ego-driven proxy battle, has also nominated former Warner Brothers and NBC Universal executive Jessica Schell, Tribeca Film Festival co-founder Craig Hatkoff, and TaskRabbit founder Leah Sullivan for election to Disney's board. The firm owns approximately $5 billion worth of Disney stock. What we call on Mr. Peltz to end his peacocking so that Disney can focus on its bright future and not be dragged backward in time. Blackwell's chief investment officer Jason Aintabi said in a statement, Disney's current leadership is invaluable to its shareholders, and our 3 exceptional candidates are being nominated along with a business proposal specifying that any incumbent director outvoted by Blackwell's nominees be immediately added back to the board following the 2024 annual meeting. Disney's Governance and Nominating Committee, which evaluates director nominations, has said it would review Blackwell's and Trian's nominees and provide a recommendation to the board as part of the governance process. But could Peltz and Trian actually win? Peltz and Trian will likely have an uphill battle to winning board seats given that the majority of proxy fights are unsuccessful. But they do have a good chance here. Jay Rasulo, former CFO of Disney, is a key component to the Peltz proposal. Time will ultimately tell if Disney shareholders vote to reject Peltz and Rasulo at the annual meeting or decide to bring them on board as the company navigates a difficult environment plagued by a declining linear business, an unprofitable streaming segment, and struggles at the box office. Peltz currently serves as the non-executive chairman of the Wendy's Company and a director of Unilever plc and Madison Square Garden Sports Corporation. Other companies where he has previously served as a board member include Janus Henderson Group plc, Invesco Limited, Procter & Gamble, Cisco Corporation, Legg Mason Incorporated, and Mondelez International. Jeffrey Sonnenfeld, CEO of the Chief Executive Leadership Institute at the Yale School of Management, absolutely hates Nelson Peltz. He told The Wrap in November that Iger's turnaround effort has not been given enough time. How many years do you want to give Bob Iger to fix the content, to make a public statement to say, look, we're going back to not being political with entertainment. We're just going to produce great stories based on exciting characters that everyone can love. What would it take for Iger to do that? It would take 5 minutes for Iger to do that. He doesn't need years to do that. And the truth of it is, Disney can never turn itself around until it does do that, until it produces content that isn't weird, that isn't off-brand, that doesn't make parents uncomfortable. You literally have millions of families now who don't trust Disney to produce stories and characters that their children can safely see. That's how bad it's gotten. That needs to be corrected. That takes a minute to correct because Disney would acknowledge and make a public statement saying, we apologize. We will never do this again. We got carried away with politics. A lot of other people did too, but we promise we will never do it again. That's all that Disney would have to do to start to begin to turn things around. And ultimately, this is the issue with Disney. Bob Iger and the board of directors give the impression they don't want anyone looking back and trying to look at the finances of Disney. Some of the big decisions that Disney made, for example, buying Fox, which is something else that Peltz has criticized, was something they spent $52 billion doing. There's probably at least $10 or $15 billion worth of mistake in there that they could charge as an expense on their taxes. That's something that should be seriously considered, but will never be considered unless Bob Iger is challenged. There's no one on the board of directors who will challenge Bob Iger or any of the other board members about some of the decisions they make. And these are very big decisions. They should be challenged, not just because it's Bob Iger, but because there is a big question as to what the future of the entertainment industry is going to be, and that certainly includes Disney. That's the business that they're in. Let me know what you think of all this in the comments below. Always love to see your ideas. Please be sure you are subscribed to the channel. Click the bell for notifications, give me a thumbs up, and I'll see you again soon with another video. And if I don't see you, I will miss you.